Hello, I'm Kamyar Rezaie, and this is Minds of Commercial Real Estate, the show that takes you behind the scenes of the dynamic world of commercial real estate. As a commercial broker to high-profile clientele in Southern California, I've grown a deep passion for the real estate industry. And in this show, we'll be exploring all things commercial real estate through conversations with some of my close friends, colleagues, clients, and partners who share my passion for the business. Thank you for joining us for this episode. Please remember to give us a thumbs up, subscribe, and of course, leave comments with any questions or thoughts you may have about the show. I'd love to hear from you. Hello, today we have Lee Kleinman with Business Finance Capital, CDC. Lee, thank you for joining the show.
My pleasure. I appreciate the invitation. Thank you, Kamyar.
Please give us a little scope of what you do.
Sure. So I work, as you said, for Business Finance Capital, CDC. We are a direct lender for the SBA 504 second mortgage portion. I've been at the firm for over 4 years, and prior to joining BFC for short, I enjoyed a 31-year career at a money center bank, where for the first 10 years I was working in retail banking. And then for 21 years, I was a business banking commercial loan officer, kind of like a loan-only BDO type role. I provided C&I credit facilities for the operating business, and I provided several real estate products, including investor transactions, conventional, SBA 7A, and SBA 504, and greatly enjoying my new role at the CDC.
Pleasure to have you on the show.
Thank you very much.
You and I have done a tremendous amount of deals on the SBA 504 side, where you've helped a lot of my clients get the CDC approved and funded, and throughout the whole process. Within the last 2 years, what have you seen going on in the market?
Well, buyers realize that it still makes sense to pay the higher interest rate versus a higher rental rate. They want to own their own property. They want to control their operating space. So we've still been very busy, even though rates have risen. The most we've seen in a very long time. Obviously, rates have gone up more than double in the past 2 years. But we've still seen a lot of buying activity, and there's also been a lot of refinance activity. So volumes are a little down, but knock on wood, we've still been busy, and there's still a lot of activity going out in the marketplace.
Very good. So we typically like to do the SBA 504 versus the 7A, and I wanted to talk a little bit about why we should do the 504 and how they're able to obtain more buildings when they use the 504 versus the 7A.
Sure. So both programs add a lot of value to the small business concern. The biggest value add is the low down payment. We all know how expensive real estate is in Southern California. On a $5 million building, a conventional bank loan could require a 25% down payment, where the SBA programs just require 10%. Many of our clientele, or our clientele per se, can't afford that large of a down payment. So that's where the SBA comes in and allows them to become building owners and control their own space. There are big differences between the two programs. The 7A has lending limit guidelines. Maximum loan amount is $5 million. There are lending limit guidelines on the 504 program as well. But keep in mind, our $5 million lending limit is just for the second trust deed. That allows the bank to perform a 50% first mortgage on top of our second. So generally speaking, a client could buy a building with for about $21 million with 10% down, as some bank first mortgage lenders will go as high as 65% LTV, coupled with our $5 or $5.5 million second. There's a $21 million building with just 10% down. That type of buying power does not exist with the 7A program. Also, with the 504, there's a green component that does not exist with the 7A program, meaning that once the small business concern maxes out their first borrowing tranche, whether it's on multiple buildings or one large building, through the green program, which you and I have utilized recently, the borrower is allowed to take on 3 more $5.5 million borrowing tranches. So just on second mortgage trust deed SBA 504 debt, a small business owner could have over $20 million in just second mortgage debt. I've yet to come across a business owner that has maxed out the borrowing power with this program. So it can really help businesses grow, especially ones that require multiple locations.
And we recently did a SBA 554 on a land deal for one of our mutual clients. And that was a very interesting where both you and we didn't know how if we can utilize the green program, the SBA green program to buy a land. And that would really helped our client.
Yeah, so this was an interesting and fun one. I think you and I learned a lot, and now we're more empowered to help more business owners in this exact situation. So your law firm client had bought a building through the 504 program last year and maxed out or very closely maxed out their first borrowing tranche, non-green. And then we were able to utilize the green program to help them buy a paved parking lot, which has the same classification as land, whether it's raw land or paved land, it's still considered land. And the SBA approved that land deal at 90% LTV. Now, granted, the client decided to put 15% down post-approval, but it's good to know that the SBA finances land or paved parking lots at 90% LTV, which is kind of unheard of in the owner-user lending space, or any lending space for that matter.
Right.
And to get around them almost maxing out their first tranche on the building purchase, we were able to use the green program. But someone might say, well, how do you use the green program on a piece of paved dirt?
Right.
There's no building infrastructure to save power. Well, there was lighting fixtures or lighting poles to light the lot at night, and we hired an environmental vendor to perform an energy analysis report to where those light poles now were powered by solar instead of electricity. And that was able to get the deal done.
Right. The green SBA program.
That's getting very creative with our toolboxes in the toolbox.
Right.
I'm sorry, our tools in the toolbox per se.
Right. So one of the major differences were on the 7A, which I know is not your expertise, which a lot of people probably don't know, is when they do the 7A and they do the 90% loan to value, the SBA wants an extra collateral for extra 5%. Versus on the SBA 7A, if they go 85%, there's no extra collateral needed and they only go based on the subject property.
Correct. So with the 7A program, they do finance up to 90% like the 504 that I provide. But with 10% down, you have to put an extra 5% down to avoid additional collateral. But it's actually an extra 7% down because you cannot finance the fee in that scenario. So on a 7A, to avoid additional collateral, you would have to put 17% down. And on a multi-million-dollar project, the client might not have those funds, and the down payment now becomes almost double what the down payment is on a 504, and the 504 does not require additional collateral. Now, full disclosure, once in a blue moon, if there's a risky deal that we do want to do, but there's inherent additional risk within the underwriting of that credit, we might want to take additional collateral to get that deal over the hump, but that's done very far and few in between. So generally speaking, the 504 does not require additional collateral.
Okay. And one thing I would like to hit on is the subject of, doing the SBA 504 on a projection-based deal, which a lot of people are not aware of, and how that, those are able to be done with the right criteria.
Yes, so that is an allowable underwriting structure through the SBA SOP, and SOP stands for Standard Operating Procedure. A bank would call it a credit policy manual. The SBA calls it SOP. So within the SOP, the 504 can underwrite and fund projection-based deals. I'm actually working on a startup right now for a property management firm, a pure startup. But let's take an existing business that has below policy cash flow ratios. If things are trending in the right direction and we think that things are going to continue with good projections and assumptions, those transactions are doable. I think at any given time, I probably have at least 5 or 10 projection-based deals going on. And as you know, I refer those clients to the Small Business Development Center, which is a nonprofit entity funded partially funded or mostly funded by the SBA, and they provide these services on a pro bono basis. So the small business owner gets access to financial professionals at the SBDC that does the projections with assumptions, business plans if needed, as a startup would need, opening day balance sheets for a startup, and putting aside the lending needs that I'm just going over right now. They have a whole slew of other services that they help the small business owner with. Formation documents with the state, accounting software setup, advertising, marketing, what have you. So I highly recommend all SBA lenders or even conventional lenders that might require some of these services for their customers to get to know their local SBDC office. Again, it stands for Small Business Development Center, a nonprofit entity mostly funded by the actual SBA government office.
So we are working on one currently that is a restaurant base, a replacement with we did the projections with that gentleman.
Yes.
And he did an amazing job. There are times when we go through a file and, the lender that I came up with and we worked with you, CDC, at some point, the transactions are like, no, we don't want this deal anymore. And at that point, you're a big help in finding a replacement lender for the first.
Yeah, so we obviously partner with all the banks that participate in the program. We're the second and the banks are the first. And I have relationships with 20 or 25 different first mortgage lenders that I routinely refer clients to. And on many of our transactions where, like you said, we had an LOI from a bank first mortgage lender that you might have selected that for some reason backed out last minute, I then add some additional value to the transaction and say, based on my experience in working with different SBA 504 first mortgage lenders, I might say to you, Kamyar, looking at the spreads, the ratios, the trends, the this to that, I feel that we should send the file to this bank or this non-bank first mortgage lender. So that's kind of a big value add in having a solid relationship with a CDC loan officer like myself or any other CDC, is that we have a great understanding of the first mortgage landscape. So we can help lending professionals like yourselves and the client get pointed in the right direction, because we all know every transaction has its own variables and strengths and weaknesses. And having worked with the banks, having worked with the banks as a 504 lender, and also I competed against the banks as a money center bank, conventional and SBA lender before I joined the CDC. Again, I have a great understanding of the first mortgage landscape, so I'm always happy to help in that regard.
Thank you. What are the advantages when you order the appraisal and phase one environmental report versus the bank ordering them?
Sure. So we can typically get it done faster, but more importantly, if the bank orders it and they back out, well, they control those reports. And not to say that they're not going to be cooperative in having the reliance letter assigned to different lenders or having different lenders added as an intended user on the appraisal, but those are just extra steps that are more time consuming that you and I have to go through in waiting for the bank to have those changes made with those vendors. Whereas if I order the reports, they're probably ordered faster, and then we control the reports because we're the client with the vendors, and we can have the changes made right away without having to go through extra people. So it gets done faster.
Lee, what are your thoughts about the interest rate market in the last 2 or 3 years? What's happening, and what do you see right now happening?
So we all know they've run up more than double in the past 2 years, but now we're starting to see a decrease. Inflation is down. Last I heard it was about 3.5, 3.7%. I know the government Fed target rate is to have that closer to 2. So inflation went from 8 to in the 3% range. And I feel that's why the Fed has paused the rate hikes during the past 3 months, I believe, 2 or 3 months. The Fed hints that they're not going to really start lowering the Fed funds rate until second half of next year. The market doesn't believe the Fed, and I think that's why we're starting to see the 10-year treasuries coming down now, because the market, I think, believes that the Fed's going to start lowering the Fed funds rate around the second quarter of next year. So that's good news, good relief for the industry, for borrowers. The November rate was 7.01% fixed for 25 years on the 504 second mortgage. The December rate is now down to 6.6. So that's the biggest drop that I've seen, I believe, in the past 2+ years. So I think that's
big relief.
A well-needed piece of relief right there. Yes. So I do think there's going to be significant reductions to the Fed funds rate. It might start second quarter of next year, but I think third and fourth quarter of next year, you're going to see some significant reductions, maybe 100 basis points. And then they're saying another 100 basis point drop in 2025. So there could be some light at the end of the tunnel, per se.
All right.
Yeah.
It's a big relief for a lot of clients.
Absolutely.
Especially those who have the balloon payments and want to refinance.
Absolutely.
In terms of the different sectors you're seeing in terms of office, retail, mixed use, what's your thoughts on that?
Sure. So there's a lot of different property types that are SBA eligible, as you've hinted to: mixed use, retail, industrial, office. Our team also financed a privately owned golf course at one point in time. I've heard of us doing a marina at one point in time. So there's a large property base collateral type that we can take into the SBA pool. But office is not dead. There's post-pandemic, obviously vacancies and values have gone down significantly. But for the owner-user space, your professional firm, whether it be accounting, insurance, medical, you and I have worked on several of these transactions where that professional has purchased an office building, occupied 51% or more, has in-place tenants to support the larger mortgage payment for the larger building. And then, so now they have a larger asset. They're going to realize more appreciation. They have in-place tenant income to support the higher mortgage. And now they have room to grow into that building by exiting tenants as their business needs more space. So they don't have to sell the building, possibly pay prepays, and go through that purchase process all over again to get into a bigger building. So I think that's one of the best strategies of this program, in the fact that the SBA only requires that 51% owner occupancy. So that allows for this type of strategy. And that can work for industrial users as well when you buy a multi-unit industrial building. And then again, depending on the industry type, sometimes you can use lot space to get to that 51% requirement if that business requires outside lot space. So that could help the industrial user get into a bigger type building. So I would say office is not dead in the owner-user space, as you and I know firsthand.
Definitely. And what about in the medical industry? What are you seeing in the medical field and doctors buying their own buildings?
Yeah, they're very active. They're smart business people and entrepreneurs, and they want to grow their real estate portfolio. And why not own the building where your practice is going to be located? So many different types of medical practitioners are buying their buildings with 10% down. So that's very active right now in the marketplace.
Okay.
Yeah.
One thing I want to clarify is how the prepayment works on these SBA 504s on the second position, which I would just want,
Sure. So it's a 10-year declining prepayment penalty. So let's just say right now, the December, for debentures that funded in December, let's say the year one prepayment penalty is 5%, because every month our rates change, and every month the year one prepayment penalty percentage changes for the prepay. So as rates go up and down, the year one prepayment penalty goes up and down as well. So let's say we're at 5% year one for debentures that funded in December, which I think the debenture funding date is actually today, the 12th.
Today.
So year one would be 5%, year two would go down 10%, so that would be 4.5% year two, and so on and so on. Year five, you'd be at 2.5% per se. And if a client does have to pay a prepayment penalty because they wanted to pay down the balance or sell the property, many accountants state that those those prepayment penalties count as additional interest paid and can be written off. But always, check with your accounting professional to make sure that that can be written off. And then on the first mortgage piece, most first mortgage lenders have a 5-year prepayment penalty. Could be flat 5, could be 5, 4, 3, 2, 1. And then many of them have the allowance to prepay up to 20% per year with no penalty.
Correct.
There are a couple banks out there that have no prepayment penalty on the first. So if you're a top tier customer, you could possibly get into that space, which is very nice. And at any time, if a client wants to refi the first and keep the second in place because they don't want to pay the second mortgage prepayment penalty, the government will subordinate to that new first. So they can always refi the first and keep the second in place, which I used to do when I was at Wells Fargo.
Got it.
So a lot of different strategies there.
Different strategies to be that can be worked out.
Yeah.
And then in terms of we have actually a mutual client that we're working on that have multiple franchise locations on different brands, and they want to start buying the real estate for each of their locations. I want to discuss that a little bit further.
Sure. So there's no limit to the amount of SBA loans that one can have. As we talked about earlier, there are lending limits, of course, but there's no limit to the amount of SBA loans. So when I was at the bank, I funded a law firm that had 7, 8, 9 locations in the Western United States. And again, no limit to the amount of loans that you can have. But as we got deeper into the acquisition process, we had to start using the green program for these additional purchases, which is fine because that's why it's there. Generally speaking, when you use the green program, in addition to hiring an appraisal vendor and a phase 1 environmental vendor, you hire the same environmental vendor will typically have an energy analysis division, and it's another report that you order on top of the appraisal and the phase 1, probably a $3,000 expense. And depending on the situation, the energy savings has to be 10 or 15% of the current usage at that site. And so it's a great strategy for multiple law firm locations or franchise locations. And it's a beautiful thing that where you can grow your enterprise with these 10% down programs, and there's no limit except if you max out the $22 million that you could have on the second mortgage piece, which I've yet to see happen. So there's a lot of borrowing power within the program, which I think is just awesome.
Also, we one hiccup we face on a current deal, I can't necessarily be a hiccup, but unfortunately with the fast food, they didn't have the 2 years ownership of that one particular brand. So they have to put 15% down versus 10% down.
Yes. So generally speaking, the structure of a 504 is 50-40-10. There's going to be some situations that require a 15% down payment or maybe even a 20% down payment. So special purpose properties require an extra 5% down. If you are buying a business and haven't owned that business for 2 years or more and don't have a similar owned business that could be considered an expansion, that could require an extra 5% down. And if you're a startup buying a special purpose, that would be 20% down. Extra 5 for special purpose, extra 5 for startup not owning the business for 2 years or more. But I would say 85-90% of my transactions are 50-40-10, and then you come across a situation or two, here and there that requires that extra 5 or possibly 10% down. But generally speaking, it's a 10% down program for your established, seasoned business owner who's either performing a rent replacement purchase or buying the building that they're leasing right now. Yeah.
In regards to the new SOPs that were released, what was the major change?
So there's been a lot of favorable changes that went into place this year, which is going to make it easier to obtain financing. So the personal liquidity test no longer exists. Not to say a business can't have too much business cash, but the personal analysis went away. Franchisees don't have to provide their franchise agreements, and they don't have to be listed on the registry anymore. The government might come back and say, we want to see the franchise agreement, but it's not required for submission like it was before. Refinancing 7(a) debt got easier because we no longer have to get an email or letter from the existing lender that says they're not willing to modify the current payment structure, we have to notify them what we're doing, but we don't have to they don't have the right of first refusal anymore per se, like they used to. And there's been a number of other changes that are just going to make it easier for the small business concerned to obtain financing. So it's been some nice changes this year.
Nice changes, and hopefully the rates are going to be somewhat on the way down.
Yes.
People can utilize the SBA program more and more.
Absolutely. Let's keep it going.
Let's get it going. We're going to have an amazing 2024. Thank you, Lee, for coming on the show.
Looking forward to
make more deals.
My pleasure. Thank you for having me.
Yep. You're a great team player.
Thank you. Likewise. Appreciate your friendship and partnership as well.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.